Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX. It's about 8:43 this morning on Wednesday, July 2nd, that I come to you from the trading floor to look over the developments of the markets this week. The markets are going to be closed on Friday in the United States for Independence Day holiday, and we're already starting to slip into a little bit of that holiday mode. We'll probably see action start to thin down a little bit over the next couple of days, but there's plenty of news developing that we need to be continuing to follow. As we look at this morning's market specifically, we're seeing the equity markets pull back a little bit. A disappointment in this morning's ADP employer report. This is a private sector report. The correlation with the government's monthly jobs report is not good, but it does give us some indications of what we might see in the government's monthly jobs report. That report would have come out on Friday, except Friday is the Independence Day holiday, so it will come out tomorrow, July 3rd, instead. Now, the general expectations are that we would see modest growth in the employment sector numbers for the month of June, looking at somewhere around 139,000 from the monthly jobs report, 115,000 for the June growth, down from 139,000 in May. But this morning's private sector ADP report shows that the private sector lost 33,000 jobs in June. So contraction in the employment sector. If you put that together with the Challenger job cut report, which shows that announcements of potential layoffs dropped almost in half in June, down to just under 48,000, down from almost 94,000 in May. So when you put together these numbers, it would suggest that attrition is lowering, and particularly when you look at the Jolts report that came out yesterday showing a big jump in the number of posted job openings, it looks like attrition is opening job positions up, but they're not being replaced and they're not being filled at this point. Now, we have to keep in mind that roughly half of the jobs typically listed in the Jolts report come from smaller businesses that tend to be more nimble to be able to respond to changing conditions. Big corporations are still worried about the uncertainty of tariffs and the tax bill, and we'll talk more about that, whereas the small companies, small businesses, those that employ like 250 or less can make quicker adjustments. So they're a little bit more adept at coming in and hiring or maybe posting job openings, whereas corporations are allowing their employment roles to shrink right now to make sure they're in a better fiscal position in case things go south. And by going south, I mean tariffs pull down the economy and or Congress fails to pass this tax bill, resulting in a big tax increase for them, which will decrease business going forward. So they're, due to the uncertainty, they're holding off until they get more certainty. Now, where is the certainty with that tax bill? It passed the Senate yesterday, midday, early afternoon, by the narrowest of margins. And by the narrowest of margins, I mean Vice President Vance had to cast the deciding tie-breaking vote. So now it goes to the House. It started in the House. The Senate changed it. The House can accept it as is and vote up or down. And the Republicans in the House realize and understand that if they vote it down, then they have to carry on their backs the biggest tax increase in history that would come at the end of this year because the tax cuts of 2017 are not extended. And we also face a fiscal problem in August when the Treasury Department runs out of money because it's bumped up against the debt ceiling. And they've used up the reconciliation bill. They get one per year in the Senate, which requires 60 votes to move a bill forward for discussion, debate, and for a vote. And so the Republicans face a choice. Do they risk this all falling apart by sending it to conference committee or sending it back to the Senate with their own amendments, or do they just swallow hard those who don't like the changes the Senate made and accept it. Now, the House leadership is still determined to get this on the president's desk by Independence Day so he can have a ceremony of signing it on Independence Day. That's easier said than done. That creates some problems. So, House Republicans have some tough decisions they need to make on how they're going to handle this. If they send it back to the Senate with amendments, it's not going to be on the president's desk by July 4th to sign in all likelihood. But that's not critical either. What's critical is that the debt ceiling be dealt with by August. And so there is some time from that standpoint. Now, the longer it goes, the more chances everything could fall apart for the Republicans. And of course, that's what the Democrats are hoping for in this. Now, Elon Musk, the world's richest man, has taken up his battle once again against this bill. And he's become the hero of the Democrats in doing so, even though they're still seething over his cuts when he was in charge of the Department of Government Efficiency. The strange bedfellows of politics on display here. Now, Musk has threatened to use his resources to challenge any Republican who votes for this bill because it doesn't do enough to cut spending and to be fiscally responsible. And I get that. I've been warning for years that Congress has been fiscally irresponsible and put us in a bad situation. But I would say that the emphasis is misplaced here because Congress will never be fiscally responsible as long as the voters in this country reward those for being fiscally irresponsible. In other words, they vote for people who will give them what they want when they want it and will worry about how to pay for it later. And that's why most Americans have big credit card bills. And that's defines the culture we now live in. Congress will become fiscally responsible when the voters of America reward them for being fiscally responsible. And we're simply not at that point. So, really, what we need to be devoting our resources to is educating the voter on the negative implications and impacts and risks that we face as a result of the current pattern that we are in. Now let's turn to the commodities a little bit here. We're seeing crude oil prices firm a little bit here. We're seeing a little bit stronger demand indications domestically and globally, some optimism that we are seeing more progress between China and the United States, and also here in the United States. Even though I mentioned the jobs bill, we're still seeing some indications of some resiliency in the economy. And the weaker dollar also gives some modest tailwinds for the commodity sector as well. When we look at the grain and oil seeds, we saw soybeans rally modestly overnight while corn and wheat prices declined. We're seeing a big winter wheat crop right now. And we do definitely have some quality issues in some areas that had some excessive rains, but the yields are high. And overall, we're going to have enough good wheat. And then those areas with bad wheat are going to have to find ways to blend it to get rid of it. But overall, our problem is bushels, and that's pressuring wheat prices. And it's not just here. It's the Black Sea is keeping prices, world cash wheat prices low, and that's a problem for U.S. wheat prices right now. When we look at corn, we have big acreage. Yeah, it's a little bit smaller after the June 30th report, but it's still big. And right now, the crop ratings have the models pegging above trend yields. Yes, low to mid 180 bushel range for yields for this year is what the yield models currently show. Pick your model, whichever it may be. And so you do the math, and that suggests ending stocks for the 25-26 marketing year above 2 billion bushels. There's nothing bullish about that. Yes, old crop exports are stronger than what USDA is reporting. That will, I believe, further reduce ending stocks for this year. But we're not going to run out of corn before this year's harvest, with possible exception of some regional areas that may, but basis market will take care of moving those bushels around. So as long as the weather remains favorable for pollination for the corn crop, that raises risk to the downside for the corn crop. On the other hand, soybeans, Their risky time, their weather time when weather is critical, doesn't come until the end of July and August, so there's still time. The biofuel program continues to develop. There's still a lot of unknowns. We don't know the small refinery exemptions yet, how the EPA is going to handle that. 45Z moved through the House and the Senate, looks pretty good so far. The RVO, which is in a comment period, so far looks good. And so assume domestic demand is good. Exports, not so much. China usually starts really getting aggressive in buying US soybeans for fall delivery in July and August, but they're not there yet. In fact, this week they bought a bunch of soybeans from Argentina for fall delivery. They're sending a message, but the market so far is kind of ignoring that. And they're concerned about what if we have a weather problem. That's providing a little bit of support along with the biofuel program. There are certainly risks to both sides here on soybeans. If we get weather problems and a strong biofuel program and China waives the tariffs and does buy some soybeans, we could have a very bullish situation. If China stays out of the market, the biofuel program gets weakened yet before it's finalized, and we have good weather, we could dramatically grow stocks. Soybeans could go either way. For now, the funds are maintaining some ownership. So that's the story we see as we enter the 4th of July holiday weekend. Coming out of the 4th of July holiday weekend, the weather models, the 15-day outlook tends to look deep into July through the midway point of pollination for corn, and we tend to see the market trade that the first trading day coming out of the 4th of July holiday, whichever is the weather threatening or is it favorable overall. We should also know next week whether we get trade deals announced. With a number of trade deals being negotiated, will we see some significant trade deals? Will they have implications for the commodities? What will President Trump do for those countries with which we do not have a trade deal? Will the big reciprocal tariffs come back on again? Will we have turmoil in the stock market that spreads over to the commodity markets as well? The next week to 10 days are going to be big for us in the markets, something we have to hang on to. We'll keep you updated from here, from the trading floor. Look forward to seeing you all then. In the meantime, have a happy and safe Independence Day holiday, and we'll be back with you as the news develops.